Financial accounting is the process of recording, summarizing, and reporting a company's business transactions through financial statements. These statements are: 1. The income statement, 2. The balance sheet, 3. The cash flow statement, and 4. The statement of retained earnings. Financial accounting is a branch of accounting focused on recording and summarizing business transactions to prepare financial statements that reflect a company's performance and financial position. This type of accountant gathers all the monetary activities of a business and reports them in standardized documents like the balance sheet, income statement, and cash flow statement. The goal is to provide an accurate picture of the company's financial health over a specific period and at a certain point in time. By following established rules and principles, financial accounting ensures that the information presented is consistent and comparable across different reporting periods and companies. Why is financial accounting important? Investors, lenders, and shareholders all depend on financial statements to assess a company's profitability, stability, and growth potential. Therefore, financial accounting plays an important role in the business world because it creates a shared financial language for communicating business results to all these groups. Financial accounting also promotes overall transparency and comparability across businesses, which strengthens trust in the financial markets and supports a stable economy. By following common principles, companies are held accountable for disclosing essential information. Financial accounting is a branch of accounting concerned with the summary, analysis, and reporting of financial transactions related to a business. This involves the preparation of financial statements available for public use. Stockholders, suppliers, banks, employees, government agencies, business owners, and other stakeholders are examples of people interested in receiving such information for decision-making purposes. The International Financial Reporting Standards, IFRS, is a set of accounting standards stating how particular types of transactions and other events should be reported in financial statements. IFRS are issued by the International Accounting Standards Board, IASB. While financial accounting is used to prepare accounting information for people outside the organization or not involved in the day-to-day running of the company, managerial accounting provides accounting information to help managers make decisions to manage the business. Cost accounting aims to compute the cost of a production or service, facilitate cost control and reduce costs. Objectives: financial accounting and financial reporting are often used as synonyms. 1. According to International Financial Reporting Standards, the objective of financial reporting is to provide financial information that is useful to existing and potential investors, lenders, and other creditors in making decisions about providing resources to the reporting entity. 2. According to the European Accounting Association, capital maintenance is a competing objective of financial reporting. 3. Components of financial statements. Cash flow statement. The statement of cash flows considers the inputs and outputs in concrete cash within a stated period. Income statement. The statement of profit or income statement represents the changes in value of a company's accounts over a set period, most commonly one fiscal year, and may compare the changes to changes in the same accounts over the previous period. All changes are summarized on the bottom line as net income, often reported as net loss when income is less than zero. The balance sheet is the financial statement showing a firm's assets, liabilities, and equity, capital, at a set point in time, usually the end of the fiscal year reported on the accompanying income statement. The total assets always equal the total combined liabilities and equity. This statement best demonstrates the basic accounting equation. Accounting standards often set out a general format that companies are expected to follow when presenting their balance sheets. International Financial Reporting Standards, IFRS, normally require that companies report current assets and liabilities separately from non-current amounts. A GAAP-compliant balance sheet must list assets and liabilities based on decreasing liquidity, from most liquid to least liquid. As a result, current assets/liabilities are listed first, followed by non-current assets/liabilities. However, An IFRS-compliant balance sheet must list assets/liabilities based on increasing liquidity, from least liquid to most liquid. As a result, non-current assets/liabilities are listed first, followed by current assets/liabilities. Owner's equity, sometimes referred to as net assets, is represented differently depending on the type of business ownership. Business ownership can be in the form of a sole proprietorship, partnership, or a corporation. For a corporation, the owner's equity portion usually shows common stock, and retained earnings, earnings kept in the company. Retained earnings come from the retained earnings statement, prepared prior to the balance sheet. This statement is additional to the three main statements described above. It shows how the distribution of income and transfer of dividends affects the wealth of shareholders in the company. The concept of retained earnings means profits of previous years that are accumulated till current period. Basic pro forma for this statement is as follows. Retained earnings at the beginning of period plus net income for the period, dividends equals retained earnings at the end of period. Financial accounting is a branch of accounting focused on recording, summarizing, and reporting the transactions from business operations over a period of time to present an accurate picture of a company's financial position. These transactions are summarized into financial statements, such as the balance sheet, income statement, and cash flow statement, that show a company's performance and financial health. Unlike managerial accounting, which is used internally to guide decisions, financial accounting follows standards like Generally Accepted Accounting Principles, GAAP, or International Financial Reporting Standards, IFRS, to ensure consistency and reliability. Financial accounting uses established principles to create consistent, transparent financial statements, such as balance sheets and income statements, which are essential for external reporting. U.S. public companies follow Generally Accepted Accounting Principles, GAAP, to provide reliable financial information to investors, creditors, and regulatory bodies, while international companies often adhere to International Financial Reporting Standards, IFRS. Financial accounting can be performed using either the accrual method, which records transactions when they occur, or the cash method, which records them when cash is exchanged. Principles like revenue recognition and the matching principle ensure financial statements accurately reflect a company's financial position and prevent misrepresentation. Common users of financial accounting include investors, auditors, regulatory agencies, suppliers, and banks, all of whom rely on the clarity and accuracy of financial reports for decision-making. Financial accounting follows set principles that depend on a company's rules and reporting needs. Companies and organizations often have an accounting manual that details the pertinent accounting rules. U.S. public companies must follow GAAP to give consistent information to investors, creditors, regulators, and tax authorities. The statements used in financial accounting cover the 5 main classifications of financial data or financial accounts, which are revenues. Included here is income from sales of products and services, plus other sources, including dividends and interest. Expenses, these are the costs of producing goods and services, from research and development to marketing to payroll. Assets, these consist of owned property, both tangible, buildings, computers, and intangible, patents, trademarks. Liabilities, these are all outstanding debts, such as loans or rent. Equity, if you paid off the company's debts and liquidated its assets, you would get its equity, which is what a company is worth. Revenues and expenses on the income statement help determine the net income. Assets, liabilities, and equity accounts are reported on the balance sheet, which utilizes financial accounting to report ownership of the company's future economic benefits. Essential financial statements explained. Balance sheet. A balance sheet reports a company's financial position as of a specific date. It lists the company's assets, liabilities, and equity, and the financial statement rolls over from one period to the next. Financial accounting guidance dictates how a company records cash, values assets, and reports debt. A balance sheet is used by management, lenders, and investors to assess the liquidity and solvency of a company. Through financial ratio analysis, financial accounting allows these parties to compare one balance sheet account with another. For example, the current ratio compares the amount of current assets with current liabilities to determine how likely a company is going to be able to meet short-term debt obligations. Income statement. An income statement, also known as a profit and loss statement, reports a company's operating activity during a specific period of time. Usually issued on a monthly, quarterly, or annual basis, the income statement lists the revenue, expenses, and net income of a company for a given period. Financial accounting guidance dictates how a company recognizes revenue, records expenses, and classifies types of expenses. An income statement can be useful to management, but managerial accounting gives a company better insight into production and pricing strategies compared with financial accounting. Financial accounting rules regarding an income statement are more useful for investors seeking to gauge a company's profitability and external parties looking to assess the risk or consistency of operations. Cash flow statement. A cash flow statement reports how a company used cash during a specific period. It is broken into three sections. Operations, these are the costs of a company's core business activities. Financing, this is money the company receives from taking loans or issuing shares, as well as money paid in interest on loans and dividends to investors. Investments, this is money that comes from buying and selling the company's investments, such as securities or fixed assets. Financial accounting guidance dictates when transactions are to be recorded, though there is often little to no flexibility in the amount of cash to be reported per transaction. A cash flow statement is used by management to better understand how cash is being spent and received. It extracts only items that impact cash, allowing for the clearest possible picture of how money is being used, which can be somewhat cloudy if the business is using accrual accounting. Shareholders' equity statement. A shareholders' equity statement reports how a company's equity changes from one period to another, as opposed to a balance sheet, which is a snapshot of equity at a single point in time. It shows how the residual value of a company increases or decreases and why it changes. It gives details about the following components of equity. Share capital, money raised by selling stock in the company. Net income, any profit after expenses and deductions. Dividends, the part of the profit that is paid to shareholders. Retained earnings, whatever is left after paying dividends. What is an example of financial accounting? A public company's income statement is an example of financial accounting. The company must follow specific guidance on what transactions to record. In addition, the format of the report is stipulated by governing bodies. The end result is a financial report that communicates the amount of revenue recognized in a given period. What is the main purpose of financial accounting? Financial accounting is intended to provide financial information on a company's operating performance. Though management can analyze reports generated using financial accounting, they often find it more useful to use managerial accounting, an internally geared method of calculating financial results that is not allowable for external reports. Financial accounting is the widely accepted method of preparing financial results for external use. Who uses financial accounting? Public companies are required to perform financial accounting as part of the preparation of their financial statement reporting. Small or private companies may also use financial accounting, but they often operate with different reporting requirements. Financial statements generated through financial accounting are used by many parties outside of a company, including lenders, government agencies, auditors, insurance agencies, and investors. Financial accounting provides a standardized framework for preparing financial statements, ensuring consistency and comparability across companies. These statements, like the balance sheet, income statement, and cash flow statement, show a company's performance and position for external users such as investors and regulators. Unlike managerial accounting, it focuses on external reporting and follows standards like GAAP or IFRS. By promoting transparency and accountability, financial accounting builds trust and supports informed stakeholder decisions. Thank you for watching this video.